Good morning, namaste. So this is our 35th episode with a slight change in the timing. We were getting some feedback that let Sunday be purely for the family, let Sunday be for other things. So we are now shifting from Sunday 1 p.m. to every Saturday 11 a.m. We understand that still it will not be suitable to all, but I don't think there is any time which will be suitable to all our audience. So today's subject is on the valuation, which is very, very important subject for any kind of resolution or any kind of liquidation to be completed successfully. Any error in valuation, any delay in valuation, any overvaluation, any undervaluation can impact the success of an insolvency professional, may he be a RP or be a liquidator. The Indian triple IPI, the IPA of Institute of Chartered Accountants of India, they were working on this guidance note for valuation, and which is applicable to the insolvency professionals as well as to valuers, because this is the kind of best practices that they have provided in this guidance note. This guidance note was, in fact, originally it was circulated in October 22, and then it was getting comments from the market. And once the comments are completed, the final document will also be released. Let me share my screen to straightway go on the subject. So this subject is, in fact, very large, and I would not be interested in spending 2 or 3 episodes on this. So therefore, I would be able to complete primarily that part which is relevant to insolvency professionals, how they should appoint valuer, how they should interact with the valuers, how the information can be provided. However, the second part of this guidance note is on the valuation methodology, the process to be adopted by the valuation valuers, the format of the report. That I will simply quickly run through only for the understanding of an insolvency professional, that what should be the report format, what should be the time format. So that's the today intent. So it will be only one episode subject, which is the background guidance on valuation process under IBC. Best practices also can be told, and this guidance note has been, it is the draft which is issued by triple IPI, the draft only. Okay, friends, going ahead with the draft note starts with a very kind of phrase given by Aswath Damodara, professor of finance at Stern School of Business, New York University, USA. And the kind of statement that he made, valuation that is not backed up by a story is both soulless and untrustworthy, and that we remember stories better than spreadsheets. The importance of valuer, it is not something which is suitable to all kind of scenario. Each valuation is a story in itself. It is not something which is a complete based on a formula, based on some arithmetic or mathematics. Each valuation is a story, and unless a story is told to valuer, unless a story is believed by the valuer, unless a story is verified by the valuer, the valuation cannot be complete. So the it is very important that we should understand valuation, because this is actually being used for various important decisions in the commercial world. But we all know that for any loan that we take, valuation is required. Now, any investment analysis, capital budgeting, mergers and acquisition transactions, financial reporting, taxable events to determine a proper tax liability, litigation. So these are the various valuations, and the context would be different in each valuation. As I tell, that the story for each valuation has to be seen, understood, and believed by a valuer. Then only perfect valuation can be done. Now, for an investment analysis, there can be a different valuation context. Capital budgeting, for a mergers and acquisition. For each and every context, the valuation can be different. So therefore, story is more important than the actual valuation. One must know the story. Now, the regulators on the business valuation in India have evolved swiftly, because see, this in the last 1.5 decade, but I would say in the last 5 years, it has actually evolved swiftly. There are regulations which has been made. There are different laws where the valuations are required. Earlier it was not required, now it is required. It is also used as mispricing concerns from the tax, transfer pricing concerns from the tax department, forex control and public shareholders perspectives. So these are the various valuation requirements which has come under the Companies Act also. Insolvency code has been added. And to drive the fair value of the assets, liabilities, the financial reporting has also required now some kind of valuation. They're like the valuation of accounting for ESOP, valuation of investments, impairment purposes. So for the purpose of even financial reporting, the valuation is required. Let us consolidate what is the kind of law that require valuation in India. For any fresh issue and transfer of shares, valuation is required under the Companies Law, Income Tax Law, Foreign Exchange Management Act, and regulations thereunder, and Securities Exchange Board of India. For any business combination, mergers, amalgamations, demergers, valuation is required under financial reporting, income tax law, and company law, and SEBI. For any employee stock option and sweat equity, there is a valuation requirement under financial reporting, income tax law, and company law. Insolvency and bankruptcy code, maybe that all the participations may be knowing that it is required. Valuation is required for finding resolution and also for liquidating the company. And even for liquidating the company, there can be a different context while the company is being liquidated in different clauses of Regulation 32. Like in case the company is being sold as a going concern, there can be a different context and the valuation can be different. Whereas in case it is to be sold on piecemeal basis, the valuation can be different. Therefore, the story is more important. Like for example, a thermal power plant. If I say that it is to be sold as a going concern, then the building of a thermal power plant may be usable. But if I try to sell this on piecemeal basis, then only the plant and machinery, which part of it may be scrap and part of it may be even usable in other places. And the building of a thermal power plant hardly can be used for any other purpose, so it can be valued only as a scrap. So the context and use of the valuation, objectives of the valuation, story of the valuation is very, very important, which cannot fit to all. It is a specific assignment. Each valuation assignment is a specific assignment, and there cannot be any format. Format can be for a report, but there cannot be a format for a text. Financial reporting, fair value is required for financial reporting in accordance with the Indian accounting standards. That's also known. Now, the objectives of the valuation. I've been telling right from the beginning of this webinar that story also includes objectives of the valuation. So in some cases, the valuation is very, very time bound. So in case we don't adhere to the timeline, the entire objective can be unaccomplished. So in case we try to cover under IBC, the objective of the valuation is ensuring time-bound resolution, value maximization, balancing of the rights of the stakeholders. Then under IBC, the valuation of asset is one of the core features. The process of valuation is like to help to determine the current value and the liquidation value. So as far as the IBC is concerned, there are three classes of assets: plant and machinery, land and building, and the securities and financial assets. And the key objective is to be transparent and have credible determination of the value of the asset to facilitate comparison. So in case the valuation is not there, then the insolvency professional, COC, or even the NCLT, they would be just playing in blind, playing in dark. So the valuation and appropriate valuation shows them the path. Fair valuation, liquidation valuation, realizable value, it all shows them the path to make a decision, considered decision. So the valuation is used for each and every action under IBC, like when the distribution is taking place, the valuation of the security interest. When the resolution plan is being considered, the valuation can be on fair value or in liquidation value. When it goes to liquidation, then the valuation also can decide what mode of sale or manner of sale is to be accepted or is to be adopted in this case. So all this is the objective of the IBC valuation. Now, in case we have seen there are disputes between financial creditors, operational creditors, and between interest secured creditors because of the valuations of each security interest. So all this is, to my understanding, the valuation can bring harmony in the resolution or in the liquidation process, and the valuation can also bring disputes between the stakeholders. Now, in case there are difference in two valuations, that can also create some trouble for the IP or for the insolvency professional. So in case the valuation is undervaluation, then there may be abnormal gain by the resolution applicant or promoters of the company. And the loss of realizable value, the operational creditor, financial creditor will end up losing money. It will cause loss of reputation for the valuers also. In my experience, in my couple of cases, the valuation was X and we have achieved 3X. So that's like, what is the first, rather than complimenting the liquidator, the stakeholders immediately asked this question. Whenever we announced in the stakeholders consultation committee meeting that the asset worth 5 crore as per the valuation, as per the liquidation value, has been sold for 15 crore. So rather than appreciating the liquidator, they simply ask, who was the valuer? Who was the valuer? So that was the first question. Of course, like thereafter, they appreciated that the liquidator has not misused this information or misused this report. That's the only way appreciation. But the liquidator has not increased the value. Liquidator has not increased the value of the asset. The liquidator has only made a kind of transparent and authentic efforts to sell the property. So that's the only appreciation to the liquidator. However, the asset has actually realized its own value. liquidator has not added value in that. So therefore, the first question which was asked by the stakeholders, let us know the name of the valuer so that we can delist, we can de-empanel that valuer from our panel. That was the first question. And later on, they also appreciated that the liquidator has not misused this valuation, and liquidator has not caused any loss to the stakeholders. So this is the impact on the valuer for giving any undervaluation. Now, in case the valuer becomes overconscious and gives a higher value, then the resolution plan will be rejected. The liquidation process would be delayed, because there are regulations which says that you can reduce 25% after the first failure of the auction, and then you can reduce only by 10%. So therefore, the overvaluation also causes a lot of trouble. Now let's try to find out the type of valuations under IBC. So the first is the fair value. Regulation 2, sub-regulation HB of the CIRP regulation defines fair value, which is estimated realizable value of the assets of the corporate debtor if they were to be exchanged on the insolvency commencement date between a willing buyer. So the key word is between a willing buyer and a willing seller in an arm's length transaction after proper marketing, where the parties had acted knowledgeably, prudently, and without compulsion. Now, if there are conditions, let us try to understand the condition number one: willing buyer. The buyer is also willing. Willing seller. The seller is also willing. And there is no relationship between the buyer and the seller because there's an arm's length transaction. Next condition: the proper marketing was done. Proper marketing was possible to be done. The parties had acted knowledgeably. They had full knowledge of the asset. They have full knowledge of the market, prudently and without compulsion. Now, this is the definition of the fair value: willingness from the buyer, because there is no compulsion. Somebody can use marketing techniques. There should be sufficient time available for marketing. There should be sufficient investment available for marketing. In some of the cases, the liquidators are not having sufficient funds even for marketing the property. They are not having time because the liquidation process is time bound. So therefore, the liquidation is not a fair value because there are the willing seller. The seller is willing, but then seller is willing means there is no compulsion, but a liquidator is under compulsion to sell. Proper marketing, it's a question. So the difference between the liquidation and the fair value is that as I said, the environment changes. Now, the liquidation value is also defined under Regulation 2, sub-regulation K of CIRP regulations, which defines the liquidation value as estimated realizable value of the assets of the corporate debtor if the corporate debtor were to be liquidated on the insolvency commencement date. So, since the valuation is being done during CIRP, the word insolvency commencement date is correct. But in case the valuation is being done during liquidation process, then the estimated realizable value of the asset of the corporate debtor, if the corporate debtor were to be liquidated on the liquidation commencement date, would have been replaced. So when the corporate debtor is under liquidation, liquidation value may refer to valuation of assets. So the liquidation value may be referred when the seller is compelled to sell, wherein a reasonable period of time is given to find a purchaser. The seller is compelled to sell within a reasonable period of time is given to find a purchaser less than required marketing period. Now, there may be a property worth 50 crore, and normally a property worth 50 crore would require 1 year time for marketing. So, however, in case the liquidator doesn't have the time for that much in marketing, the liquidator will get less value because liquidator is under compulsion to sell. Liquidator has to close the liquidation. The liquidation value is also a notional realizable value of the corporate debtor's asset if the corporate debtor assets were liquidated on the insolvency commencement date and not the value that may be realized under a resolution plan. So resolution plan, the value may be higher. However, in liquidation, the value would be lower. Characteristically, an asset can have different value under different scenarios. So as I said, the valuation is a kind of scenarios. So we have seen so far the fair value and liquidation value. Now coming to the realizable value. See, because the IBC uses 3 words. In CIRP, IBC uses fair value and liquidation value. However, in liquidation process regulations, the regulations uses realizable value. And the realizable value is basically the value arrived after reducing the cost incurred to sell the asset from fair or liquidation value, as the case may be. Although the CIRP regulation mentions about fair value and the liquidation value, with liquidation regulations mentions about determination of the realizable value of the assets or the business under various scenarios of sale. So now we see various scenarios of sale. So when we see various scenarios of sale, so that's something which we are trying to say. Just a minute. Yeah. So for the time being, Ankit has also joined. Ankit, am I audible to you?
Very well audible. Hope I'm audible to everyone as
well. Yes. So Ankit, I started the webinar, although this is your subject, but I started with the IBC as a context. So I will continue this IBC context of the valuation, and quickly we'll run through all our participants. And in between, there are some issues which are purely valuation issues. So I will hand it over to you for sharing your experience and knowledge with all our audience.
Right.
So we have discussed, Ankit, 3 things like the fair value and the liquidation value and the realizable value, because in the liquidation regulations, the word used is realizable value when the liquidator is supposed to get the valuation done, and that too for different scenarios of sale. I had also given an example for a thermal plant. As a going concern, there is a value for the building, but for a piecemeal sale, the value for the building would be only scrap value for the building.
So I have like, of course, the draft guidelines here talk about realizable value as a separate value, but my understanding is that when the CRP regulations talk about liquidation value and define that as the value which is realizable under liquidation, or it says that the liquidation value is the value which is realizable in case the CD is liquidated as on CRP date itself. So it is again pointing out to the realizable value under the liquidation regulations itself.
Yes.
And in case we read the liquidation regulations and we talk about understand the valuation requirement under liquidation regulations, then it clearly says that the value which is required to be computed by the valuer under liquidation regulations is the value which is realizable under the various methods of sale that are mentioned under section 32. It refers to regulation 32. So that's how it's worded. So that's the chain of flow. So That's
So
important to understand.
also we've seen that the fair value means that the sale is being effected uh, under a scenario where there are willing buyers, willing sellers, and arm's length relationship, the sufficient amount of time and means for marketing, the uh, information about the asset is fully available.
Yeah.
The
So all
decisions
those
are,
assumptions, all
all
those
those are
assumptions
assumptions
have
for
to be
fair value.
taken. So those
That has,
assumptions are the exact definition of fair value is also the definition of market value in IVS in the standards in IVS 105. That's important to understand that the basis of value, that is the market value, is same as fair value, other than the idea that fair value as defined in IBC is different in two perspectives. One, it only talks about assets and not liabilities. Number two, it talks about the specific date of valuation, that is the CRP date.
yeah. So Ankit, now we move on to the next section, which is appointment of valuers as per this draft document. So the registered valuers basically means a person registered in accordance with the Companies Act and rules made thereunder. And there are types of registered valuers for like land and building valuer, plant and machinery valuer, securities and financial assets valuer. And the appointment of valuers again is given as per company's registered valuer and valuation rules 2017. There is a asset class means a distinct group of assets such as land and building, machinery and equipment displaying similar characteristics that can be classified and require separate set of valuers for valuation. So these the definition of asset class is different. However, so far IBBI has introduced registered valuers of three kinds: one, land and building, plant and machinery, and the securities and financial assets, whereas it is recommended as per the registered valuers and valuation rules that similar characteristics that can be classified and require separate set of valuers. Now, we also, under the insolvency process, we are getting the valuation of diamonds, jewelry, because there are no registered valuers under valuation of diamond jewelry. So what we are doing is, because in the case of Nirav Modi companies, so we are getting the handover from enforcement directorates for all diamonds and jewelry that was seized by them. So we are getting it slowly, but then it's a very difficult process to take control of the diamonds and jewelry. And that's something which is because the valuation is required, the inspection is required, the classification is required, certification is required, all that is required for valuation. And it has been advised to us that uh, since there are only three class of valuation, so you can give it to plant and machinery valuers, and they would appoint another valuer who has specialization in the valuation of diamonds and jewelry. However, the IBBI was not ready to give any answer in writing. So they were saying that if you are so particular, then you can file an application to NCLT so that it can be adjudicated, rather than asking from IBBI that who will do the valuation of jewelry, bullion, diamonds. Also, we are facing difficulties in who will do the valuation of trademark, brand equity, litigation. So these are all assets, uh, not that keep every class of asset would have separate specialized valuers, but yes, the valuer has the power to take any expert as an associate for doing evaluation, for completing evaluation. Any expert who actually can add value for the purpose of understanding the value of the asset. So
So
the
so
yes, okay.
this part of the guidance note, it kind of tries to bring clarity on this issue and says that in case there is a CWIP, there is an intangible asset which is of land and building nature, or which is of machinery or plant nature, then that should be taken care of by the land and building valuer or the P&M valuer. And then it talks about how the financial assets, securities and financial assets valuer should then take up the inventory along with the tangible asset valuers wherever they are required to be done together. Now, one thing that is missing in this is that sometimes, and many times rather, where there is a going concern, there the valuers, the insolvency professionals, if they are appointing a valuer or individual valuers for different asset classes, then they would, of course, understand, or rather give the duty of doing the going concern valuation to somebody specific, or they will have to then go for an entity to be appointed which can do the combined valuation for all asset classes. But again, because the regulations now talk about comparing the values on an asset class basis, in some occasions where you are valuing the company as a going concern, comparing the values on an asset class basis may not be feasible. Per se, we recently came across a case where there was a land and building, a real estate project. Now, the real estate project can have multiple parts to it. One, there is an under construction property that can be understood to be a land and building. Then there are some receivables which are standing in the books of accounts that can be understood as the SFA asset. But combined, it will always be a real estate project, which, in my understanding, should be done or valued by a real estate valuer or a land building valuer, maybe in combination or in alliance with an SFA valuer, so that the going concern nature, income, DCF approach, all that can be taken up jointly by them.
Yes, Ankit. So, like some guidance to the insolvency professionals while they appoint valuers. So, first of all, they should also keep in view the nature of business of the company, CD, the nature of assets held by the CD, and also the size of the corporate debtor. And it has been suggested in this discussion paper or a draft guidance note that the larger companies having various types of assets like real estate, machinery, manufacturing units, financial assets, it is recommended that the IP should consider appointing registered valuer entities, which is registered for all three asset classes. My personal experience also has been good because one, that the registered valuer entities, they respond whenever we send any request for quote, and they quote a consolidated fees, and for the COC it becomes very easy to take a decision, and that becomes a kind of higher stake because they have to grab the market credibility, so they normally perform better. So, but then I think the insolvency professional has to verify that for each class of valuation there are signatures of the person who is registered under that class, signatures of a registered valuer. So the next, let me take it to. Let us talk about the statutory provisions enabling appointment of registered valuers under IBC. So voluntary winding up, we are leaving, and section 46. Now, section 46 of the IBC also says that an application for avoidance transaction of undervalued, the adjudicating authority may require an independent expert to assess evidence relating to the value of the transaction. We have been told many times by the adjudicating authority that you have submitted an application for undervaluation. How do I assess the undervaluation? You also provide a valuation report along with it. So that's one area where the IP has to appoint the valuer. So regulation 27 of the CIRP regulation mandates the appointment of 2 registered valuers within 7 days of his appointment, but not later than 40 days, 47th day of the CIRP commencement date. Again, regulation 35 of the CIRP regulations says that 2 registered valuers are to be appointed. And in case the value estimates are significantly different, then they are supposed to appoint the 3rd valuer. Now, The significantly different means difference of 25% in the liquidation value of an asset or the fair value. And this difference also has to be calculated like L1 minus L2 and divided by L1. Like denominator and its numerator is like, this is very important that we divide by the higher or divide by the lower. So in case the one value is 100 and the other value is 120, 130, so the difference is more than 25. So how to calculate that? 100 minus 130, 30. So there can be two things. The difference is 30. So in case we divide by lower, then it becomes 30% difference. But in case we divide by higher, then it actually becomes less than 25% difference. So it is very clear that it has to be divided by the lower valuation. So then the 25% will be calculated.
Divide by the higher one.
25 by, see, 25
divide by the higher one. So therefore, when you divide
divided
by
by
the
the
higher
lower one.
L1 is written
L1
as
is the so L1 is the higher valuation.
yeah. So if you divide it by the higher one, then you will get the lower percentage.
So in the example that I've given, it has to be divided by 125.
Yeah.
So regulation 17 of the CRP regulation also states that if there is a change in the IRP, RP, and the appointment of resolution plans is delayed due to the unforeseen reasons, the IRP to perform functions. So that's there, like in case
I think this is all the regulations.
This is all the regulations. We can actually skip and we can take it forward.
We can look at those parts of the guidance note which is beyond the regulations, which gives some kind of guidance to everyone. I think this is also something which is repetitive, fast track and voluntary liquidation regulations. We understand this.
So this best practices for appointment, that is something that's very important because everyone should see what are the best practices for appointment. Yes, you can do that.
So basically, inviting it says that the IRP should invite quotations of multiple registered valuers, and then he can always. So how should he use it? He should use his wisdom to decide on the registered valuer for submitting the quotations, depending on the complexity and size of the registered of the corporate debtor. I think this is all generic. Seeking the approval of COC, we understand again that COC has to pass the amount, and the appointment, the choice with respect to who to appoint is the valuers. Here again, basically
this is again repetition.
Repetitive. Yeah.
So there is a discussion paper they are referring to 15 February 22 discussion paper.
This is I think already passed. So these changes have actually
no. Here I would say that this should be the standard process which can be adopted by the insolvency professionals. Now, what should be the standard process? That first of all, the IP request the appointment of professional must be laid. The request for appointment of professional, because this is not for only valuer, this is for all professionals. So the request for appointment of professional must be laid down before the COC. And now such request should also be laid along with a statement in writing where the reasons can be provided and justification be given for appointment, where the cost benefit analysis would be done, scope of work assigned, absence of such services in the corporate debtor, the manner of selection and reasonableness of the cost. All this is supposed to be placed before the COC, and the request that the IP is making to the COC, that also should accompany that he has exercised reasonable due diligence before proposing such appointment. The appointment is not a related party. He has obtained an undertaking that some professional will not associate himself in any manner with other stakeholders. Requisite disclosure has been made regarding such appointments. So the incorporating confidentiality also should be done, and that kind of confidentiality undertaking should be taken from the professionals. So these are the best practices, and also similarly the best practices for appointment of registered valuers. Again, regulation 27 says
these are all requirements where these restrictive clauses are there, and I think all these are required to be complied with.
Then the disclosure relationship also. Now this is the information sharing.
So this part is important because there is not much on this part that is part of the regulations also. So if we go through the document, the understanding here, the of course, it says that IP has the power to get hold of the books, get hold of all the information, and the powers are available with the resolution professional or IRP to access all this information. So then let's move forward and see that what all information does it talk about. So then it talks about
This
timelines.
this is a good part
So
because see,
timelines, it kind
yes,
of does an analysis that what kind of time does the RP or does the valuer have to do the valuation. So
hmm,
it says that because the IM is required to be prepared within the resolution plans are required to be received within 135 days of the CRP date, and 47th day is the last date on which the values can be appointed. So effectively, the valuer has 88 days to complete the report. So that's the kind of summarization that they have done. Similarly, in liquidation, it says that where the asset memorandum has not been prepared. So within the new regulations, the asset memorandum can be or is required to be prepared earlier, I think within 30 days in case the earlier valuation is being used, the CRP date valuation is being used. But where the earlier valuation is not available, then one has 75 days to appoint and 75 days to make the asset memorandum. And before that, the liquidator has to be appointed within 7 days of the liquidation commencement. So that is how I think these two timelines have been talked about.
yeah, yeah.
So best
So
practices in
yes,
sharing the information. So of course it says that it is recommended the RP or liquidator should start collecting the information from day one itself. So that should be a perspective that the RP or the liquidator has, that whenever they are collecting information from the CD, they should also try and collect information that would be required for the evaluation of the entity. So that is a constant exercise, whether it is the CD's management or the creditors, that information can always be compiled in a parallel manner. Uh,
I believe, Ankit, this when we actually try to make the request for fee quote or request for proposal of valuation,
mm,
one which is very important part is that the details of the assets must be given to the valuers.
yeah.
Unless the details of the assets are given, you will not get appropriate fee quote.
Yeah, and
I have seen,
in most of the cases where we get RFQs, the this information is absent. So we have to then seek the information on where the assets are located, what are the type of assets that are available, whether it's the company or the entity is a going concern or not a going concern. So like this happens in many cases. In some cases, of course, a lot of information and a very detailed RFQ is shared with us, which gives us a lot of information on what all assets we need to value. We can move this, we can
now
move beyond it.
this part
Mm,
is very important. On
mm,
14th June 22, the CIRP regulations have made an amendment. The creditor shall provide to IRP, RP, as the case may be, the information in respect of the assets and liabilities of the corporator from the last valuation report, stock statement, receivable statement, inspection reports and of the properties, audit report, stock audit report, title search report, technical officer report, bank account statement, and such other information which shall assist the IRP or RP in preparing the information memorandum, getting valuation determined, and conducting CIRP. So this should be used by all the insolvency professionals to get information from all the creditors. The moment they file their claim, immediately after that, the communication should be sent to them for asking these documents or reports. That is
mm.
what is the regulations are. And again, the this guidance note has given some kind of
No, they have
exhaustive list.
it's a very, very exhaustive list and a very, very long list that they have given that this should be the information that should be shared with RVs.
Yeah.
It's a fairly long list, and I think they have tried and compiled everything that can be
Yes,
possibly
I'm trying to
usable for
look
this.
into this sheet because I think for any insolvency professional, it will not be practical to collect all this information. So I'm just showing it to my audience that in case you really see what is expected out of an insolvency professional, then this actually will cause any stress to you. So let's look at this other part, because the information, in case this much information is required to provide it to the valuer, then it's very difficult to get this information, and also timely completion of valuation process. Next is the carrying out valuation process. So Ankit, you can actually look into this part and you can let me know the screen when to move.
So basically here the approach and process adopted by so we can understand this. So it only talk this part talks about the carrying out the entire process. So it starts with planning the evaluation process, review of the appointment letter. So this is all technicalities which are involved in a valuation process from the valuer's end. Then, so basically what we normally do practically is go through the information that is available, plan our audit, and then plan our visit, because a physical verification is required to verify the tangible assets at the CD's premises. So that visit is planned based on the understanding of the documents that have been received. Then this part is important, that how do you sell the assets, or when you want to talk about liquidation, then are you looking at going concern sale or not? Are you looking at going concern valuation or not? Or considering a going concern valuation at all? So it depends on the type of asset that you are valuing. In case it's a thermal power plant, it's closed, but let's say it's 100% complete. Then you will perhaps have to do a going concern valuation, because in case you go ahead and do a cost-based valuation alone, then you might get a value which is not a realistic value to ask from the market in case the market assesses that plant's going concern value. So also sometimes market approach helps in this, in balancing the values and coming out with the value that the market would perceive for that asset. That is the important part. So then understanding key information, limitations. So limitations that are with respect to physical inspection. So sometimes you see physical inspection limitations like lack of electricity, lack of running machine, lack of people who can assist you in understanding the machines or the plant, the way or the layout. So in those cases, you have to then trust on your physical measurements and trust on your existing knowledge database or your research or your market study. So all that becomes an important. Then due diligence and physical inspection, I think I've already talked about it. We can proceed forward. Determination of methods. So these are various methods that they have stated. Orderly transaction, market participants, valuation dates. These are various factors that they've mentioned. However, the basis of valuation that we would use in this case would be fair value and for liquidation value. And the difference would be marketability, due diligence that one can be done, the kind of data that one will get, the urgency to sell that would be there in case of a liquidation value. The as is where is basis is important, that in a fair value or in a market value, you will assume that you will be able to restart the asset and then sell. But in the case of a liquidation, you will have to sell the asset on an as is where is basis. Premise of value is more of the use premise, that how will it be used. So one is that it will be used for the highest and best use. So you can say that a factory land which is located in the middle of the city, one can say that okay, it will be converted and used for residential housing in future. So that would be maybe the highest and best use for that land, which may not be the existing use. The existing use might be using that land for some kind of a commercial or a factory purposes within the city and so on. So we can move forward, yeah. So carrying out the valuation process, then of course you have to understand the approach. I had already talked about it, using income approach, market approach, or cost approach. So in these approaches, one talks about three economic principles. So in case of economic principles, you say what is, you look at three. The one is the value of substitution. The other is the value of the economic principle of market equilibrium, or price equilibrium rather. And lastly, you talk about the economic principle of future benefits. So when you say income approach, you're looking at future benefits. What will you get in future? Cost approach, you're looking at substitution, that what will it cost to substitute this asset? And the market approach talks about price equilibrium in the market, that in case you're looking at two assets, then price equilibrium, the principle, economic principle of price equilibrium tells you that if this asset is worth this much, then your asset is worth this much as well, or rather, after adjustments, what will that value be? CLDs, there has been a detailed guidance on caveats, limitations, and disclaimers in case any insolvency professional sees any CLD or a caveat, limitation, and disclaimer which goes beyond, or which rather it says the law says that which kind of puts the makes the valuation exercise untrustable, or rather the valuation itself untrustable, then that kind of a CLD can be totally ignored. So first stage valuation, and then so normally we share the draft valuation report from AAA valuation with the RPs, and when we share the draft valuation report, the idea is to get the RP's consent on the information that we have relied upon and on the assumptions that we have taken in the absence of information that we may not have received. The resolution professional normally also use this as an opportunity to compare the assumptions taken by the two valuers appointed in the process. And wherever the assumptions are different, which cause a ripple effect on the values as well, those assumptions can be asked by the RP to the RV to recheck and confirm. In case still the reports throw different values, then the third valuer may be required to be appointed.
So this is all the valuation report
Yes.
formats, key inputs used in the report, and also the key estimates and projections used in the report. These are very, very vastly covered in this one. Consideration for liquidation process, again, they are referring to regulation 5. It's a repetitive, we can leave.
Yeah,
And
they
also,
talk about A to F again, and then
yeah,
A to
A
F
to
you
F.
have to, yeah.
A to F is high, like here, first of all, the A to F, because see, like this is also important, because I understand that the most of the insolvency professionals, they need to understand this very clearly, that in liquidation, the valuation, the realizable value that you get estimated from a registered valuer, that can be different in clause A, clause B, clause C, and clause, or even clause F of regulation 32. So the valuer must be given a task that the valuation has to be done under what kind of sale, and under which clause sale. That is something which again is not being done very regularly. But these are the the eligibility of registered valuers. This is what I was talking about. So in case the assets are supposed to be sold as a standalone basis, that has to be told, so that the liquidator can assess the value. Registered valuer can assess the value based on all these mode of sales.
So this basically, again, some discussion paper talked about, but then we do understand that the SEC will now have to
The SEC has
can
already
vote.
been,
Yeah,
it's
so
not a
that has
discussion
already
paper, it has already
it's
been
already been
constituted.
changed. Yeah, yeah.
It has already been changed now. So these are the practical issues and suggested solutions. And these are some kind of question
This is
answer.
a kind of a some kind of a Q&A issued by them. So they
We
say
actually
that
should guide our audience that they should read these Q&A, because see, why we have taken up this issue today, because the valuation is very important for all insolvency professionals, for all bankers, and for any kind of decision making for any corporate. However, the information to the valuer, the coordination with the valuer, that is very, very important. So therefore, we will advise that everyone should read these practical issues and selected answers. Rather than saying answer, they are saying suggested solution. So it's okay, but it's important to everyone should go through, whosoever is actually getting any valuation done, they should go through all these practical issues so that they can guide their valuer accordingly. All these are practical issues. Question answer also can be good name for this. Yes, and this is also very important input which is given by IIIA PI, that there is a format that they are saying that this is a format for appointment letter to the valuer. Appointment letter to the valuer, also this format has been given, but in the format they are actually having paragraphs which are only headings are given. I think this is enough, but because I said each story is different, each valuation is a story in itself. and it is only
Covering these aspects is important.
covering these aspects is
Similarly,
important.
even for valuation reports, the standards only talk about covering the various aspects and not talk about any format per se.
These are some of the formats for giving, for even disclosing relationships. So this was all. So Ankit, are we going to discuss the approach and methodology? Because we
No,
understand
I don't
market
think.
approach,
Yeah, I
we
think
understand
these.
comparable
Yeah,
transaction multi, because all this is valuers say side.
so
See
the
how the
idea,
valuations.
the idea is to basically, I think the idea of putting this part into the guidance note is that maybe insolvency professionals or RPs can also understand these approaches and at a supervisory level, so that they can make sure that if there is any method that is required to be used, then that should be used. Although nobody can expect an RP to also become a valuer per se, but then yes, the primary
Caveats,
and the
yeah.
basic. This is
Caveats
again an
CLD you have
extract.
already discussed.
This is again an extract from the mother document, that is the guidance note on the CLDs that has already been issued by IBBA and it is already in process.
So these are all, this is important. The things to be kept in mind from A to F. This is for all ready rector kind of a thing for all the insolvency professionals, the valuers. Illustrative caveats, limitations, and disclaimers in evaluation report. These are illustrative, and the asset class wise sample of caveats, limitations. So these are useful for the IPs and these are useful for the valuers also. So all the kind of paragraphs, all text is written. So this actually is a very good document. It can be used. It can be like somebody can
So
also
we
depend
have
upon it.
to say that while it is still a draft document or a draft stage, certain things or certain practices can be borrowed. Practices including trying to arrange or rather using the list of documents that are mentioned in this draft document and using that to get the information from the CD wherever possible. Then there is a possibility to complete the appointment process based on this document. Understanding the difference in the asset values and then appointing the third valuer as a guidance that has been provided very neatly here. Various methods have been talked about. Liquidation value has been explained. The question with respect to who should value the inventory has also been taken care of. So these are some advantages of going through this document that somebody can avail.
So I think this has been a good document. We appreciate the efforts made by IIIPI, and it will be useful for all the insolvency professionals, valuers, bankers, and all the stakeholders, whosoever are ever interested in any kind of valuation in any kind of processes. It is not related to, it is not restricted to insolvency processes. It can be even mergers or acquisition. It can be for even company law purposes. So I think this document would really be useful for all to read. So we can conclude this webinar today. Thank you very much. Just to give a, again, we are trying to say that from Sunday, it has now been shifted to Saturday, every Saturday, 11 a.m. Please keep your time. Please remain connected with us. We assure that we will bring subjects, topics of importance to all of you. Thank you. Thank you very much.
Thank you, everyone.